I got to hit the record button real quick, but I open the floor and we'll take this in the direction that you guys want to take it. Of course, I'm scanning the market now to see if I can get us any opportunities. But was there anything particular anybody want to dive in? We can dialogue on entries, times to trade, pairs to trade, anything you're seeing in your own personal trading. Anybody got anything before I call on somebody? I'm gonna pick on somebody. Nobody has nothing they want to dive into. It'll probably help us all, including me. Oh, yeah, that's a good one. EMA. We got on this one, we're looking at a 50. It's just a simple 50-day exponential moving average. I prefer the exponential because it's a quicker graph in time. So when I'm trading more of a short term, the EMA is more precise. So you see here we had the break, the retest of the EMA, and a nice drop. They play as dynamic or moving support and resistance. So they move along with price, give us a calculation of the 50 days of the average price. That's where the magic is because it's calculating the average or median of price. So the 50 is good because it's right about 2 months worth of data. So you guys will have an average between the past 2 months. And then we get into a little deeper of a discussion called mean reversion trading. So the market is always looking for a balance. So when you see these impulses, we call them impulses, the market, that's why you get a retrace because the market likes to correct. This is an imbalance in the market, pushing the market, to an extreme. The reason why we have those extremes is that you have more aggression on one side or the other. So either bears come in more aggressively, or if we're looking up, the bulls are more aggressive. One facade we always have in the market is that that they feel like the sellers won or there's more sellers. There's always an equal amount of buyers and sellers. One is just more aggressive than the other. That's the way we facilitate trade. So if someone wants to sell, somebody has to buy. I know that it took me a while to grasp that concept myself because I'm like, okay, why is it dropping or somebody's losing? That's what I used to always think, like somebody's losing. Why would somebody want to just lose money? But that's not the case. People are facilitating business in this model, and we get a visualization on these graphs. So somebody may have made an acquisition where they had to change over ADI to or yen to ADI or ADI to yen. That's going to be what the whole exchange is. So they had to make that transaction. Somebody wanted to buy a business. Let's say hypothetically, somebody wanted to buy a business in Japan that lived in ADI. So they made a call over to their bank, aka the broker or whatever financial institution, and they started facilitating their trade. They said they wanted to put it in at a certain price. They got that trade started going, and it starts to move. Now, this is just a concept, but it helps you guys rationalize what's going on the chart. So they were more aggressive. He didn't care what price. He wanted to just get this business done. And, he don't mind the price dropping because, the yen went up. So he went from ADI money to yen money, making it a more, making the yen way more, or making the yen worth more value. Sold the ADI, switched over to yen, so there's more yen than there was AUD, and it caused the AUD JPY to drop. Start looking at the concept of like the seesaw. You have AUD here, yen here. We're looking at strengths. Which one's going to be stronger, AUD or the yen? If the AUD was stronger, not draw it just for kicks and giggles. A lot of these concepts, once we get it, it's gonna make your trading a breeze because you're gonna stop just looking at these assets like um, pairs, and you're gonna start looking at them like future traders or institutions look at them. They look at them like single currencies. So that's a little bit more in depth of a lesson that's, currency strength. But I want to get you guys to that point. I just want to make sure that everybody's on the same level. I don't want to dive too deep and leave anybody behind. So, we can spend time in chart patterns or whatever we need to until our, whatever area. So everybody, the roughest part is getting familiar. And what a lot of people know, we're getting familiar with the mechanics of operating, let's say MT4, operating trading view. And that's how I look at, chart patterns, technicals, um, even some strategies. Like it's just the mechanics of actually operating and facilitating or executing a trade. Now that's one basis of trading, but you guys want to know the concepts are the macro, I would say, of the actual process of trading, so you know why that's happening and make a more informed decision. So um, it does also go back to this is speculatory, so no one can be right 100%. I'm getting back. I wanted to. They drove me to try to make sure that I teach you guys because I've been getting frustrated with seeing how much fluff and hype is out there in the industry right now. Like they sell a lot of bull crap that's really not sustainable, but that's neither here nor there. So I'm just gonna try to pour into you guys and see if we can create winners instead of worrying about what I'm seeing. But there's a lot of things out there right now that causes people to have what I call a casino effect. We start looking at some of these guys, some of these strategies, but underneath the basis, a lot of it doesn't hold the test of trading. So that'll be that. So we're looking here at add somebody else in. I'm looking here at AJ. We want to look at a chart pattern. We got a chart pattern right here. We got a right shoulder, a head, a left shoulder, a head, a right shoulder. Typical head and shoulder pattern. We consider this, once again, trend lines are so subjective, but we can consider this the neckline. We had a break, like we may get up and get a retest, or we can consider, comes on to your personal preference or perception, we can consider that a neckline. Honestly, it'll probably be more not that low, but it'll be more, let me get this, be more this level here. The rejections there, market stop there again. Kind of a little fake out right there. Pushed up. We got the form of pretty much like a little head and shoulders. It's a retest, so this may be something we can actually get ready to trade and know how to market moves on an hour chart. So push it here. The cool thing about this is double trend line. So with this double trend line, there's extra fortification, extra fortified. So typically we should see a reaction, maybe a little bit of a wick and a pull back down, and we at least get back down here about another 50 pips. Might see a good push down. Currently, I'm watching JPYs. Only thing that's going to be really pretty active for me. We'll take a look here at GJ, see if we see anything. And I'll go over my whole process. This is a nice trade as well. Took nice pullback. One of my favorite forms of trading is, zone to zone. Uh, some sleep on support and resistance, which here gives you clear indications to where you want to facilitate trade. Um, Let me add somebody else in here. Where you want to facilitate trade at doesn't necessarily mean that, you know, these are concrete or that, you know, price has to respect these areas, but it does give you an indication of where you want to facilitate trade at. So we get impulses like this that's they're there to cause liquidity basically. So you see the trend's been down, but they'll pull a overexerted move. Um, so we'll touch one topic of manipulation. Without manipulation, the market wouldn't really move, and manipulation isn't necessarily a bad thing. When you get pokes like this, the powers to be, I would say, are the banks and hedge funds. What they're doing is they're actually accumulating, or they're actually collecting orders. Um, so I'm trying to keep this on a base level. So in order for someone to take profit, they have to, their order changes from a buy order to a sell order. It's just the way it happened. If you buy it, the only way to get rid of it is to sell it. If you sell it, the only way to end that actual contract or that order is to buy, to send out a buy order. Um, so that's a little bit there on that end. So you see this little bit what some would consider, you know, manipulation, but the broker is actually looking. Here I'll give you guys an insider look. So we pull this up here. This is pretty in depth. This is kind of similar to having a view of what pro traders would use called an order book. It won't be exact, like I'm not seeing exact orders, but I am seeing the volume of the orders that's in the actual market. Now, I don't typically have to use this to make a trading decision, but I do use it at times where I want to see there's low volume of volatility that lets me know where, you know, that push could stop or where there could be potential reversals. So basically that's what the market is looking for. You see, when he pushed up, there was nobody on the other side of him wanting to sell or counteracting this movement. So it just kind of shot up on thin liquidity in straight air. So it shot up, nothing to stop it. So that's why it was so exaggerated or so big. Once they get to a key point, they finally found orders. So we have to look at it like when they had a big move, there wasn't any orders here that was selling to slow them down, slow them down. That's what he was actually looking for, was a sell order big enough to stop that trend. So once he got up here, he started collecting orders, started getting orders for sale, or he either took profit, which causes the retrace. So I don't want to go too outlandish yet and confuse anybody, but you see the trend was down. They had that exaggerated move. What had happened was people that unfortunately were on the wrong side, they hit stop losses, and they also incited people to go long. And then what they do, they shot the price back down. So it's called inducement. They induce both sides. It's kind of, I call it for anybody that play hezzy cross, right, familiar with basketball lingo. They shoot the price up real heavy. They induce buyers, breakout traders. Um, then they bring it down. So first they induce sellers, point blank. Bam, they break a zone. They got people starting to sell, jumping on a lot of my breakout traders, and they hurry up and swoop it in the wrong way. So they hitting everybody's stops. At the same time, the people that was waiting up here for this breakout zone, they got them in the mix. And bam, they shoot it back down. And they hit both sides of the stop, and then they move in the initial direction or which direction they were looking to move it to. So the trend, I always say, they say the trend is your friend. The trend is your friend until it ends. Most success I've had is with what we would call mean reversion trading. So I like to see things like this. I like to see a real nice snap, and then I like to catch based on some certain criteria. I like to catch the move back to this mean. first of this call, we were talking how 50 days is kind of like a median. It likes to snap back to the mean, take the profit, then it can come back down and create another low. So there are a few steps in trading you have to combine. You want to know like structure, market structure, higher highs, higher lows. You want to know. I did a candlestick walkthrough a while back, so you start seeing different avenues to tell when these candles are getting smaller, the spreads getting smaller. It shows reversals. But you want to add those things into a itinerary for you. So, we spend a lot of time strategy hopping, looking for different strategies. There's really no holy grail. There are some things that work during different markets. There's some things that don't work during different markets. So I'm saying this to come back around full circle that the the best experience I had in trading, and I got a couple of $1 million mentors. What they it's probabilities. You have to learn how to lose. You have to learn how to take a loss in this field, but you have to learn how to lose correctly. You have to learn how to lose, and you have to learn how to win more than you lose. So we all know, we look for the right thing. So we do have to know our knowledge on how to get in, get out the trade. There's different things that makes us a sharpshooter or a little bit more precise with entries and things. But behind all that leg work, the faculties that's at play is only probabilities and ratios. Probabilities and ratios. So once you get those two things done, like your win rate, excuse me, not even your win rate, because most hedge funds win between 50 to 60%. So you're looking at once you get your actual risk to reward down pat, you knock off some of the factors. I won't call it greed, but the wanting to have the whole cake in one sitting. It's gonna do tremendous. Gonna do a lot for your trading. And after a couple of weeks, you're gonna be like, hey, okay, I can actualize a week. Now I can put on those 10, 15 lots. But I just see a lot of like this. I don't see it no much more, especially like I said, my core group. Everybody's getting a little bit more refined. I see a couple of new people jumping in the room, but most of my core group is kind of getting tightening down, and I'm starting to see everybody gain profits. You know, each week, every day, I see everybody getting better. So I really say that to some of the newer people in here. Once again, risk to reward, starting to take a journal, having your trade plan. Some of the things that may be mundane or seem like a nuance is where you're gonna win your trading. Like, yeah, I can show you guys a strategy, and if I didn't really care about the people, you know, I can be just like every other mentor I'm sitting out there, and I give y'all a strategy that'll win like 60, 70%, 80%, and I can tell y'all just to do what y'all doing, just watch y'all, and it'll look good on me because people will put on high leverage, you know, accounts, high leverage trades, don't care about the risk to reward or the being over leveraged, and then I can just take screenshots. Somebody made like 2,000, but then they come back the next 2 weeks, they blew that whole account. I see it time and time again. They blew the account because it's like a ticking time bomb. It's like setting you guys up for landmines. This market is full of sharks, landmines. So we want to try to keep it on one accord where we can exploit the market and know what we're doing without having the excitement of fear, greed, the adrenaline of winning, because that's what makes a great player. Like anything from any games of risk. I hate to make the comparison to like a casino, but it's a casino effect. But if we're gonna play, if this is something like with risk, we want to model our trading just like a casino. Yeah, we'll give them a little bit, but we know we're gonna have the edge at the end of the market, at the end of the day. So the edge is key. So you guys might see me holding on to some long trades, or you guys might see me get like 2 or 3 stop loss hits in a row. And I'm like, hey, oh, what's going on? But then at the end of the week, I'm up 400, 500 pips. I didn't increase my account. You know, I'm putting some nice size on it. So here I'm finna kick the gloves off, and I'll start showing, you know, these big, just for motivation, show some of these nice trades I've been taking because I've been having some pretty big trades. Um, so I'll start showing those just to motivate everybody, but it's finding a balance. I don't want everybody to go out there and try to just recreate because it gets into a vicious cycle. I was there for like a year where I was dumping money into the market, just dumping money into the market, just if I could find the right strategy, the right time to enter, the right, and then I finally sat back and it wasn't none of that that made me make a transition. So we'll go into some price action, like simple things like this. You keep it very simple. You don't have to have nothing. I mean, I put different overlays, but I mean, with this, you can see a double top right here. Double top with something backing it. It's backed against the wall with the EMA. That's a trade all day. Indeed, bro. It's a trade all day. So the chart work, becoming a chartist, you want to keep it clean charts, keep it simple. Where the work is done is behind all this, the concepts behind it. Um, so give me a one. I've been kind of going along. Give me a one if everybody's still on board with me, and we can dive into. You know, I try to keep it entertaining. I try to keep some jazz on there and do some chart work, but we'll dive a little deeper into like mechanics. Cool. I got y'all all still with me. Indeed. So people may have heard. I'll go over two concepts, and I'll go over some chart techniques that I use. But people may have heard me say the running man. We do the running man. Some people may also heard it as the power of three, or you know they like to say there's three moves down, three moves up before reversal, three you know impulses, pullbacks, and then you get a reversal. I like to look at the running man concept because to me, there's no exact three pattern. It could go four times, it can go five times before the market reverses. I also want to dive into the aspects of that we're actually trading what we call an auction market theory or auction market. This is actually a live auction and it's ran on supply and demand. Supply and demand. And then you have the nuances of traders or banks facilitating trade. So you have them lying in wait with pending orders. So I mean, we can see something like this here. So we see whoever's selling program was initiated. Typically, what happens is this is going to be your supply area. They accumulate it. So there's a lot of accumulation, which is going to be just that pinball ranging type of area. They accumulate it. That's another concept we'll dive in and give you a full roundhouse kick. So they accumulated. Bam, they started the selling program. And where did they come back to? They came right back to retest, but they impulse. They cause people to, oh, it might break, try to go long. And then they short it real fast in order to hit stops. What those stops do is those buy orders turn into sales, give them enough liquidity to move it down to another level and eventually push the price on to the area that they were trying to get it to. And they created a new low. They got a low, came back up, created a new low. We may get another low, a third formation, a third low. So we see this audit, this area here. Sorry, I was getting a call. Okay, so we see this area here. This is a supply zone. Get a drop, it comes right back to the supply zone. So this is a trading method in itself. We identify supply and demand areas, and then we only facilitate trade at those areas. So I see them start, I identify the supply area, I let it drop, or actually on this particular example, we were able to get a very early entry because the way the market runs is they run the program or the selling, and they like to come back to retest the actual supply zone. So you get one, not one, but you get three. You get one test, you get a initial drop. See the big large candle. We can call it a shift candle. So it shifts out of this upper zone, comes back, retests it, drops again, retests it, drops again, come back for a final retest. No one is interested in buying this market, pushing this market up. Get a nice big drop. Eventually, you guys get to the point to where your risk is in check, so you're able to do this. You see it drop, you wait for it to come back. That's one entry. You see it drop, you come back. You don't freak out. That's another entry. You see it drop, come back. There's another entry, and bam, you rewarded for it. Now you can't do this if you have $1,000 account, $2,000 account, and you're trying to put a 50 cents lot. But if you were to break that down and you were able to go point 0.5, let it come back. 0.10, let it come back. Point, 10 or point whatever to make it to 0.50, the market is going to reward you because what you're doing is an inside. You're trading like the banks. We have to remember the banks can't put 10 million contracts at one area because they're going to tank the market without having their full size on. So they may need to they decide here that I want to make a acquisition for 40 million contracts. And again, when I say contracts, because we're talking about future traders, they usually facilitate, and that's what pushes the market. So they want 40 million. Well, they put in 10 million here to test the market. Okay, there's no opposition, no opposing force. The market drops nicely. They say, okay, so I got that much of a reaction out of the market. I'm gonna keep my 10 in there. At this point, a previous zone, you have, buyers may have stepped in. You have some buyers step in, and they start the initial. The big dog comes in. He protects his area. He's just like a dog. He protects his territory. So he puts in, maybe smaller, maybe 5, because he don't want the market to completely tank, because then everybody's going to start trying to sell, and he won't be able to get in all the orders. So he puts in, maybe 5, lets the market come back up, because remember, the market has to correct. The market loves balance. It always searches for balance during the transactions of buyers and sellers. So in the meantime, you got the banks, you got everyday economy moving, which causes them to bounce up and down. It comes back to his area. He puts in, this time 7 million contracts. He says, "Oh man, okay, look, I'm kind of running out of time. People are tired of me pushing it back down, even though they're trying to push it up." So he goes ahead in his last round up. He gets a little move up. Bam, he puts in all his full size, and he has his program just running. At this time, whoever this was here that was competing against him, they're like, okay, he won the tug of war of the Bulls and the Bears. I'm tired of putting in, because every time they put in order, this is money that's coming out of their size. So this guy, little guy here, may have had 10 million contracts he needed. So he put in 5, and he noticed that, against that 5, that 10 initially, he was able to put in 5 contracts and pushed it up a little bit. But hey, something's happening. Every time he puts in money, put in another 2. Price don't want to go up. Puts in another 3, it doesn't want to go up. So at this point, he takes his loss, or he's done facilitating his trade, and it allows the market. There's no one here competing against him. So we start looking at these different principles, and that lets us understand what's going on behind support and resistance. Let me delete that. So we get an understanding of what's going behind these support and resistance areas, so we can make a more informed decision on how do we want to interact. So we can look at it 2 ways. So they talk about the range. So you guys will see the range here. Market stuck in between these zones. It was also a previous zone here, so we know price likes to kind of, somebody's there's a balancing act done in this area typically. You know, they collect orders or accumulation. Some of my more veteran traders, there was an accumulation or a distribution pool here, a order pool or order flow, or excuse me, order block, order block here. So they got done facilitating all this trade. Brokers are taking orders in and out. If we looked at the old school, like 70 tickers tape, you know, that'd be people on the floor yelling buy, sell, and we see who has the most aggression. So kind of give you a visual, we'll bring back up this. One. And this will bring back around from the auction market theory. So from that example, you guys kind of see how it's similar to an auction. Do I got 5, 10? Can I get 15? Well, this is downtrend because you know we can make money on both ends, but we're going up. We'll go 5, 10, 15, 20. Do I got 25? Do I got 30? So that's how the market moves up until we get to the highest bidder, whoever willing to pay the highest price. It doesn't matter if this price is up here, if somebody's willing to pay for it, market, it's where the market will go to, all the way back down to the lower seller. So there are economics in these charts, but you don't have to be an economist to trade them. You can actually just look at these levels because they give us the blueprints. You see these wicks. You start seeing ranges. You start noticing supply and demand. So you're not doing math calculations. You're not doing, but you do want to know the bare bones are kind of the background story. So let me pull up this right here. Word of advice would be to start, you know, if you really want to take this thing to another level, spend a few moments, back away from trying to find the perfect setup and study some of the greats. There's a good book called Market Wizards. You can YouTube, you know, Forex traders, great Forex traders. And a lot of these concepts you're going to start hearing these guys talk about. And it'll snap the puzzle all the way in full circle. So now you're going to be efficient in whatever strategy you choose to use, whether it's, you know, just an EMA strategy, whether it's going to be something more advanced, like there's a supply and demand. See, the supply came in, dropped the market. You want to use Bollinger Bands because I can sit here and teach you guys a strategy all day, just like, you know, buy on outer bottom band, sell. But on the times where there's no volatility, where, you know, the market conditions change, where there's no trending, there's only a choppy market, it'll leave you lost in the sauce, and you're just gonna be getting your stops hit, and you don't know why, and it causes you to revenge trade. It's a vicious cycle. You revenge trade, you scale up, you're losing more money when you just got to scale back and, you know, rein in your psychology. So I even, you know, it's even rough for me to talk about. It kind of gets not redundant, but the psychology, because this is not where the action is. A lot of people like to see the action of what's actually trading, but, you know, so I'm taking a list of who all I spoke with, and we're gonna break this down and continue to dive into the market. So that'll be my little bit of a lecture on concept. Like I said, just study some of the greats. Jesse Livermore, Richard Wyckoff. You can look at I want to say Peter Branson. What's my guy's name? He's a newer trader. I'm trying to give me 1 second. I'm trying to pull up his name. These guys all made millions and billions in this actual space. I'll post his name in a group. So I'll break down my process real quick before we jump off, and I'll open the floor for any questions. But basically what I'm doing, like I said, I like to start with a 3D approach. I like to have a sentiment bias so I can get a bias of which way I think the market's going to go. Then I like to have, you know, my technicals in line, and also my psychology at play. So I like to do what I like to test the market. I like to throw a little bait out there. So I may put like a little micro lot, see how the market reacts, wait for a pullback, put in more size. First thing I'm going to do is I'm going to try to find a sentiment or a bias in the market. I can do that one or two ways. I can either look at the strengths and the weaknesses in these different currencies. And from knowing the background about the currencies, I can come up with a conclusion of which is going to be stronger or weaker. Shortcut though, for you guys, until we learn all that, shortcut is going to be just simply whatever pair you're trading, check out these little economic reports by top tier economists. They're going to tell you what's going on. Look, it even trading bias. I can't make it. It tells you the bias. Like it tells you that they're going to be looking for the big boys and the institutions are going to be looking long. Now these guys are just economists. They don't always trade, so they're not 100%. But that's going to give you a good puzzle piece to the market. So I didn't really read into this yet, so I wouldn't say just go long. Of course, it looks to me it's looking could potentially be bearish, but just off of first sight. So you want to look at these. You can even pull them up. This is something on client positioning. I mean, that couldn't be a better example. Sentiment, client sentiment. Our data shows traders are now net long for the first time since April 14. So people are starting to go long on this pair. Just because the clients aren't representing banks and hedge funds, we'll go deeper into what we call the COT report. The COT report shows the actual banks and institutions. So most retail people are wrong, or they lose money 80 to 90% in the market. So that's why I don't listen to a lot of these so-called gurus. And that's how you guys got to get. You got to get into what I call kill the noise and get into the zone. And anybody can trade, but it's that all that outside noise, all the outside, real psychological that makes it hard. It's because we got so much getting thrown at us. But 80 to 90% of the traders are wrong. So you can use what we call the COT, and we can look at what the banks and hedge funds are doing, because they look at all this information. They have all this data. So they use that data to make a trading decision on where the economy should go. And usually when most of the retail traders are going one way, the banks are going a complete opposite way. And you just take the trade the way that the bank's going. And probably about 80 to 90% of the time, you're going to win. It's funny. Of course, you got to have the right entry point. Not saying exact or perfect, but you do have to have a good entry because it's based on your account size. So if I go in there and I'm too over leveraged, I can have the trade right. I can have the direction of the trade right, but the trade wrong because, other outlining factors. It's not my entry. It's not my time frame. It's that I may have put in too much in the account, so I couldn't hold 30 pips of drawdown. I couldn't hold 50 pips of drawdown. But if I would have sized appropriately, that 50 pips would have paid me out 300 pips just the next day. Let me get how many in the group has gotten a trade, got stopped out just to see the next bar, the next few candles, it went like 100 pips in your direction. Anybody had that happen? Exactly, Michael. So that's what's kind of going on there. Now, I'm not saying every time you want to be too conservative, but you want to get yourself in a rhythm. This is just like playing. I don't know if I got any people to play sports, any people to play sports back, any sports, any type of competition, any games, anything like that. If you just competitive, you got to sometimes you got to build a rhythm. You may be the best player at a card game or at whatever you like to do. You may be a machine at it, but once you first sit down, you may need to dust off the cobwebs. So that's the process I'm trying to get everybody into, is just to get settled. Let's find you guys a strategy that you like. I'm not saying you have to get off and just have instant results, but let's give that strategy 3 or 4 days of just testing it. Okay, I don't like it when I use it at this time. I like it when I use it on this pair. I like to use it on this pair. And I'm not discrediting anybody, but I don't see a lot of people doing that. That's the missing element that I don't see people doing, is actually doing that back testing, giving the strategy time to actually work. And then you can do the calculation. So now you're gonna put down, okay, every time I take this trade at 9 o'clock, for some reason it's winning. You're gonna start noticing that, like, that win. So now we exploit that. We exploit that edge. Now you have a sound edge over the market. So you're like, every time this cross right here, this crosses at this time, particular time, you start noticing stuff like that. Like on a Wednesday, if I get an EMA cross, 80% of the time, it's gonna win. So that's where you can put in the full standard lot. You like, okay, I know every time I need to have at least a 10 pip stop loss. I know that it's gonna go for like 50 pips. I can put a full standard lot here. The 10 pips is only gonna risk me, say maybe, with a standard lot, that'd be $100. But I'm willing to put down that $100 to be able to gain 2,000, or, let's be more real. Let's say $1,000. I'm willing to do that. So that's where you get 1-to-1. So it's easy in concept. It's easy when you're saying it. Actually doing it is where you have to put in the work and you have to practice. Like I said, I'll start showing some of my bigger trades, but I don't want to be, and by far, I'm still trying to level up as well. So I don't put myself in crazy risk like that. Because I did that, I would have days where I would hit like a 4 or 5 grand day. And then, a couple weeks later, I would be back at 2 grand, a grand. And it was just a vicious cycle. And it plays on your conscious. It plays on your emotions when you feel like you almost there, and for some reason you can't never break through. You have a nice round of trades, and then you give all the money back. So that's that on that. I'll run through a quick chart here, and the last thing while I'm thinking about, I want to touch on is, if you have a good week, for me, withdraw at least $25. Buy yourself a pizza. It's kind of esoteric, but it puts you in the mind frame of winning, and that you can actually start seeing money out of this. Um, it's turtle, not the hare, and then the turtle end up getting a turbo jet on them, and you just start exploding, and it will do some things. That's where you start paying bills, where you start paying your rent, start paying car payments, and then you get up to the point to where you're acquiring new purchases. You're getting ready to go buy that new house. You're getting ready to go buy that new car. You're getting ready to do some things in your community. If you're not, materialistic, you're getting ready to do things for yourself and for others, because you didn't put in the groundwork. So we'll take a look here at this chart, GJ, and I'll take one request, and then we'll open the floor real quick, because we've been going for about an hour. I've been going away for about an hour. But I hope I'm giving you guys some value. I'm hoping I'm not too abstract. I'm hoping you guys are taking something out of this little shindig we having. So let's go into my favorite part, everybody's favorite part. Let's look at some technicals. Oh, here, let's make it even easier. Let's jump into this real quick. We'll make it even easier. And I'll give this out if anybody wants this chart layout. Something I put together. We have things that I mark up on the chart. It's marked off for you. So as you guys get more proficient with marking, then you can do that. But we got support and resistance, you got supply and demand zones, you have volume here, you have channels. So it puts out any channel, trend channel. Of course, it bounces channel to channel. This is more subjective because it doesn't show. The rules is to have at least 2 touches on each side before it's a valid channel. This is going to draw off any 3 connecting data points. So we have price This is a exotic currency. Looking for these to continue to push up, and it's actually going to be my entry. Let me take this trade real quick. I just want a small position size on that. Look for this to continue to push up these chart highs, and I think it's going to go way higher than that. Yeah, I'm looking for it to come up to previous highs somewhere around here, possibly up there. But I'll take profit somewhere around here. And as this start progressing in my direction, because of the spread, there's a little gap, but it's already kind of pushing up. We were about right here when we first started. So starting to go in my direction. We'll hold this trade. But the way to use this actual setup, we were looking at GJ over there. Okay, you got your channels telling you trend direction. You got an EMA. It's going to tell you trend direction, and we'll create a strategy right here real quick. If it's underneath the 20 EMA, we're at the top of a channel, and you have either an arrow or a line you're going to sell. Let's make sure. Those are heavy confirmations. Or you can use this. You have as long as you have a line, or you can put your back against the wall, something to lean on. Prices underneath the 20 EMA, it's going to be a sell. You always can sell that. So I'll send this out. If anybody wants this, I send it to the group. You guys can play around with it. If you've seen just like I did, you'll start finding this is where you guys are going to create your own strategies and start being able to create your own. I should have took that sale. Be able to. It's still going to be time to take it though. I want to see it break. But you guys be able to start your own strategies. Your own. It's called building a system, because there's a strategy and then there's a system. Your system is more robust. Your system is going to include a strategy, like buying after this, but it's also going to include all your rules, like your trading plan, your trading journal, the time frames you're trading, whether you're trading on a macro or micro. So you have GJ, let's go here. You have the cycles of the market. You're starting to see M's and W's. The market moves in M's, W's, V's, A's. I call it the ABC, the alphabet soup of the market. You also have days that the markets do certain things. So you typically can look for a reversal between Monday, Tuesday, and Wednesday. So Wednesday, you got to push down the final impulse, went back to a previous level. You got the reversal coming in Thursday, Friday. Now, it's not always textbook, but it gives you kind of a key to where you should be and when you should be trading. So, you know, from Monday, Tuesday, Wednesday, and I think I got a YouTube video on this, but I'm going to steady record one. But Monday, Tuesday, Wednesday, the market, you can expect some type of reversal. Unless there's extremes going on, like right now we are in the corona, so JPY was expected to be very strong. So when we dive into currency strength, that helps us. But see, just right here by doing a cheat code, looking at the little thing, yen may rise. So if I'm knowing yen rise and I'm trading GJ, I may be like, hey, since I just seen it, I might not want to buy GJ, even though it usually reverses on Wednesday. I may not want to buy it because they just now told me that, look, the yen loan obligation. So I'm showing you guys behind the scene where most people, they just trying to sell y'all courses and programs, and they're not showing y'all a lot of this stuff that really makes the market move. Because we're really in economics. So, you know, the credit market, the retail market, the you know, the economy or the money market, all these things have a counter link to each other. So of course, like it's all you know, it's ruled by the mighty dollar. We trade Forex, which is actually currencies, but you got to think, okay, how do the credit market run? It behind the base, there's some type of money associated to some type of intrinsic value. So you start seeing the values and the money, because that's all the change. You know, currency is a rate of some type of intrinsic or value we put towards something. So you see these markets like the stock market, you see, okay, when they're selling off, where is that money going to? It's not just disappearing in thin air. They're selling those contracts, taking that money, they're diversifying the risk and moving it over to things like they're hedging. They call it hedging into gold. They may buy gold. They may buy um, Japanese yen as a safe haven. They may buy the Swiss franc. But these are big money plays that we're able to watch out day by day through these charts. So we'll see the stock market kind of go down. We'll see the gold probably go up, potentially go up. I mean, it's been doing that for the last few days. So gold went up. Investors are starting to get spooked. And then this trickles over to the actual currency market or the stock market. Now we don't see a big, so well, we did see a nice movement. This is going to be the correction. Feds are pumping in money. They're trying to keep everything afloat, but until we have some type of head for the virus, unfortunately, some type of vaccine, some type of breakthrough, a lot of this is just going to be pumped money into the market, which is, if you guys are familiar with, potential bubbles like the dot-com burst, they're just inflating that bubble. They're steady blowing in, which could bring hyperinflation, things of that sort. But I'm not no expert. People will argue with some of the thoughts. I'm not no economist, but they should have let the market reset, because it looks like it's going to be on the way for a reset anyway, and we could get a potential another low. Everything's trickling over to the credit market. They're relaxing. Some of your people credit cards, you'll notice that some of the criteria is changing with every day, like credit cards already getting loans. So they're already forecasting it, and they're doing all this information. But we're not the last, because we can start reading these charts. But average society, we're the last to kind of on the totem pole. So we don't, they just kind of put us in the catch-22. So they're bailing out these banks, these big businesses, and they sit in America $1,200. But I don't like to stay. I'm not gonna be political. I don't want to get into that rhetoric. But this is a great equalizer. I can say that. Once we home down, and I hope I gave you guys some type of motivation. It was in depth what I'm saying, but anybody can do this. We just got to take it a step at a time. Step one, kind of find your sentiment. Step two, whatever technique you're using. If you want to use the EMA, if you want to use, price action, double top, double bottoms, it's gonna be your second part. Number three, we're gonna start getting into volume. You can see when the big boys, they can manipulate price, but they can't hide transactions in the volume. So that's gonna be part of your system, actually building a system. You also have to take, data taking, taking down what trades you took, why you took them. Was it a win? Was it a loss? So you don't repeat the same mistakes, and you can improve upon the edges or the things that you're doing right. So point blank with all that, you have to run this with a bit like as a business from the jump. I don't care if we're trading $100 or we're trading $100,000. You have to run this as a business to get the results out of the market. So I'm gonna leave it there. Does anybody have any? Oh, I'll send off this actual template, and let me see if I can find us a trade real quick. I'll get us a trade. Bam! This might be the one right here. We can short. If anybody's not in this short, we can short IDJPY. Not IDJPY, IDUSD. We'll have a stop loss. Well, what we'll do is we can wait for this. Two ways to play this trade. If you want to be more aggressive, we can take the short now. put your stop loss at 7. Let's give it about 30 pips. So 30 pips here will be 6.4, 6.4. Let's say 6.430. The reason I say 30 is because it's a good number, but if you look here, it breaks this zone here. So we always look to the left to see where we're at. 30 pips will get us above this zone. Once it breaks above this zone, there's nothing really stopping it, so we'll know it'll be more of a long bias. The reason to take the sell is that we're at the top of the Bollinger Band. The stochastics is pointing down. We're starting to get a price action pattern here. So we're just waiting to have more confirmation of the fall. We want to see this break here. But if you're more of an aggressive trader like me, we kind of have our back at the wall. So I would go ahead and take this trade, personally. We got this here as a backing. I'll be more aggressive. I'll take the trade to the downside. If it breaks here, then I'll start making decisions. If I want to work my way out of the trade, I can either get out fully, let the price come up, see if it'll retest. If it retests, there's a higher probability it may break this upper area. So I can even reposition myself and go long, once I see confirmation of the retest. So that's a strategy in itself too. You use stochastic, you see stochastics down, you see it at the outer Bollinger Bands or the outer bands, upper bands or lower bands, and you see that they're in sync as far as the stochastics and where the price is. You can take the trade. That's one confirmation. That's two confirmations. That's the whole thing about trading. Besides the 3D approach, you want to have all your confirmations when you're taking that trade. So that's one confirmation, two confirmation. I have a resistance line. I have a wall to put my back against. That's three confirmations. The more confirmations, the higher probability to trade. Fourth confirmation has been in a downtrend. That's my fourth confirmation is starting a downtrend. Now, as far as take profits, I like to base my take profits on higher time frames. But if we were looking like the same time frame, bam, that would be a take profit. I don't like that trade because it's not enough room. I'm risking 30 pips to only get 30 pips. So that's a 1-to-1. I like to have more room. I go to a higher time frame. I pick out an area, another roadblock. Okay, look, it stopped at this area here. Was at the bottom of a band. It stopped twice here, so there's something there. There's somebody there moving the price. That'll be my new take profit. It's about 200 pips. So now all I want to do is monitor when I get to these levels that I feel like it may stop. So when I get down here, I'll look at the trade. Is it a big candle pushing through? You have to have a big candle to break these areas. You see right here, bam, big candle. That's how you know it's going to break that zone. Let's find another area where I can show it again. Bam, big candles. Big candles are going to break. You can't break a support and resistance zone without a big candle if it's a legitimate zone. So we're looking for this to bring us a pretty nice size candle. It may even come here, pull it back a little bit, nowhere, and then give us that nice size candle for the breakthrough. And that's how you put your take profits. That's how you find your stop losses. Was that clear with everybody? We're kind of about 8:07. Go ahead and end up the call. Was that? Let me get a one, or let me ask any questions.
Was this recorded?
Yeah, I got it recorded. I got it.
It's hard to take notes when you're trying to catch everything.
I hear you. I gave a brass today. I didn't have any structure. Just kind of going over a couple things, but we're gonna home in. So if you watch the replay and you see any area that you want to just tag in, we'll spend a class just on that particular area. And I'm glad you said that because I do need to break it down. This was kind of just a free for all, but I'm gonna start doing just one section of entry, Bollinger Band, and we'll break it down piece by piece in these next few days of upcoming weeks.
Okay.
Let's see, but yo, that's about it I got for everybody. Hope y'all enjoy the rest of y'all evening. If y'all have any questions, I'll put this thing in the chat, and y'all take care.